Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. The last of the big main drivers here since late spring and throughout the summer, as well as going into autumn and now winter, has been the construction of the June to date double bottom pattern. It is a lopsided double bottom, but is nevertheless still there. The market has most recently been scaling upwards on the second part of this double bottom. Prices came ever so close 3 weeks ago to confirming it as a pattern, but bottled it in the middle of the week. As I said 3 weeks ago, to justify such a pattern, and I quote, you would need at the very least prices to exceed and properly exceed the 50% Fibonacci line of the June to October 2018 move at 22.21, end of quote. They did not manage to do that then, but this week we have seen another attempt, and yesterday for the first time since early June we have seen a close above 22.21. This brings me to the two recent patterns that have been dominating the action since late September. The late September to late October bullish Andrews pitchfork, which is highlighted in dark blue on my daily chart, and the bullish shift pitchfork with the same move, which is highlighted in purple. The bullish Andrews pitchfork showed the bullish angle of attack since late October until being tested in late November, with breaches below the lower time, currently at 22.35, nearly every day since then. However, in that time, it has still showed the bullish angle of attack of the market from late November until now. I drew the shallower bullish shift pitchfork in direct response to the breaches of the lower time to show a possibly better, if shallower, bullish angle of attack. And this has been fine bar a minor breach of the upper time, currently at 22.62 in mid-November. Here comes the rub. Not only do we have a big potential double bottom pattern mentioned earlier, but we also have either a possible bullish halfway hesitation or a possible double top formed over November. Cannot tell yet which, as it very much depends on what the market will do with the 22.21 level. Then on top of all that, we have a crossover of tines, of the lower tine of the bullish Andrews pitchfork and the upper tine of the bullish shift pitchfork. And it will be happening this week. On Friday, I suspect. You can see the crossover circled in bright red on my daily chart. For those who know me well, they will tell you that I often comment on time crossovers and what they mean. So, from Friday, for a few sessions afterwards, usually you may expect one or more of the following to happen: a change in trend, a reinforcement of an existing trend, volatility. I'm looking forward to an interesting week and early part of next week. LME 3-month tin. The story here since late June has been a series of stratified support levels that in late August became a series of stratified resistance levels, which have once again become a series of stratified support levels. The major ones are at the following levels: between 23,000 and 24,155, 21,360, and 20,435 to 20,510. Recently, the market's descent ceased in early November and prices turned higher, prompted by congestion at 17,525 and just ahead of the September 2020 low at 16,970. This pullback overcame some, to be honest, lightweight resistance, but then tackled and punched through the slowly rising short medium moving average, currently at 25.75, the now flatlining medium moving average, currently 21.870, and pushed up into some of the banded area resistance I previously mentioned, between 23,000 and 24,155. Mid-November was the earlier high water mark for that move higher, with prices pushing up clear through the congestion band, but soon running foul of another older congestion band between 24,750 and 25,050, dating from February 2013. However, the decline only went really as far as the medium moving average below, plus a few dips of the congestion below that at 21,355. Yet this dipping did not last, and since then we've seen a gradual erosion of resistance and the turning of the medium moving average from resistance into support for an attempt higher into those older stratified resistances overhead. Finally, there is one final point I'd like to reprise once again. 3 weeks ago I said, and quote, The action since late August has caused me to think that perhaps the action is a possible descending scallop pattern. I would like to see more on this to be sure, but right now it looks like a lot like that to me. I'm minded therefore to give just a provisional idea on the upside for such a pattern, assuming of course it does not peak and revert back down, which would also be in line with this pattern. But for a continued move higher, you would have to look primarily in the 25035 area, and possibly later on, should it continue, up to the 27475 area. I'm not ready as yet to start naming targets for this pattern, but it's worthwhile being prepared just in case, as I can easily discard these if they prove unsuitable. End of quote. I've been minded since then to look at the action as a possible descending scallop pattern, as the fall in late November was in line with such a pattern. However, prices have since halted their fall, returned around, and are now challenging the November high, which indicates a potential break higher. If this happens, which can happen any day now, then the topside provisional ideas become targets of 25035 and 27475. And they will most definitely be in the frame. To be honest, the 25035 area is not that big an ask at the moment. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. Here comes the final bit.